Hello, welcome everybody to the A to Z of valuations. We are going to be discussing specifically 409A valuations, what they are, why to get one, and how to get one. Wanted to introduce our two panelists, Tim and Kayvon, and let them kind of introduce themselves to you today before we get started.
Thanks, Priya. Hey, everyone. Tim Poydanis here from Goodwin Procter, emerging company venture capital attorney over here. I've been practicing down in Santa Monica in the Silicon Beach area for about the last decade or so. The overwhelming majority of my practice is working with early stage companies, with startups, first time and serial entrepreneurs. So really looking forward to the panel and talking about some topics and issues that I'm sure all of you come across in the early and late stage days of your company.
Sounds great. Kayvon, would you like to introduce yourself as well?
Yeah, sure. Excited to be here and thanks for having me. So Kayvon, my background did sales and marketing, firefighting, everything that was needed to run a company. I ran this division called Preferred Return, did a management buyout, ended up running it as CEO, helped a lot of founders along the way, ended up selling the company to Carta, getting acquired, then sort of joining team here. A few months ago, I've been helping founders for the past 10 years. And I think the main focus of me joining and my team joining Carta was the history of the company. We've started helping founders issuing stocks and options. And then since then, Carta's helped something close to over actually 20,000 companies with everything around equity management. So our software platform is now used by founders and lawyers like Tim and the team here at Goodwin to do everything from board management, compensation planning. And so that's my background and that's why we're here.
Very cool. Well, we are happy to have you both. Just a few housekeeping items before we begin. We have our opening legal disclaimer. So this is a general presentation about rapidly changing issues, and it should not be construed as legal advice because we are not considering the facts of your specific situation. However, if you have a particular situation on which you need advice, please feel free to reach out to your Goodwin contact or to any panelist here. Due to the scale of this event and to help in its management, we've intentionally disabled the video and audio features for non-presenters and panelists. Please use the Q&A feature to present questions, which we will take at the end of the discussion. Please note we are recording this session and it will be made available on the program. So now that we have the legal disclaimers out of the way, which I hope you expected because it's we've got lawyers on, we can kind of jump into the Q&A. So I have the first question for Kayvon. What is a 409A valuation?
Yeah, sure. So I think some background is helpful, right? So in 1999 and 2000, so Enron stock is trading somewhere between $30 and $100. And what they were doing was instead of just giving their executives income or salary, which taxed quite high, they were giving them the option to buy Enron stock, but the purchase price was very low. So they were allowed to buy these stocks at a very low price and then just go to the market and then be able to get the stock that was trading at a very high price. And so fast forward to after the Enron scandal, 2004, the Jobs Act comes out. And as part of the Jobs Act, there's a section called Section 409A or IRC 409A. In that Section 409A, they talk a lot about executive compensation or non-cash compensation. And there's a language there that says, if you are giving somebody the option to buy stock in your company, the purchase price of that has to be equal or greater than what the fair market value is. And a fair market value has to be set by an independent third party, and it needs to be documented in a report. So that report is called a 409A report. So a lot of time people just shorthand talk about this 409A report, where you go to a third-party independent who is a qualified appraiser to give you this report that will tell you what is the value of your stock. And so that's essentially what a 409A report is, and that's where it applies to a lot of private companies where founders are issuing stocks to their employees or their contractors. Priya, you're on mute.
Because I've
The
never
music,
worked
but
a camera before, clearly. This is all new to me. What's happening? Sorry. So thank you so much. So Tim, why is a 409A evaluation important to an early stage company?
Yeah, for sure. Hopefully I'm off of mute on my end. I think
You know how to work a camera.
Priya and I are part of the technology group at Goodwin. So listen, and I think that Kevon and myself, we're going to talk about it over the course of the next 45, 50 minutes here. The importance of a 409A valuation, how it comes into play with early stage companies and late stage companies. Kevon hit the nail on the head talking about Enron, 409A being issued by the IRS, the ruling coming out. But I think the underlying reason why it's the most important, one of the most important things for early stage companies is it's the only way to effectively grant equity to employees, your early employees, your late employees, your service providers in a IRS corporate security law compliant way to avoid penalties going to both the company and also to your employees and to your contractors, your advisors, any service provider. So when it comes to founding a company and it comes to growing the company, one of the most important things, Kevon's going to touch on this in a minute, is incentivizing folks with equity. And at the very base of being able to do that, you're going to have to obtain a 409A valuation from a third-party service provider. Otherwise, folks are going to get riddled with tons of tax hits, tax issues, and then also from the company perspective, you're also going to be assessing penalties. But then more importantly, when you come to your ultimate exit, whether it's an IPO or you're getting acquired, there's going to be tons of diligence liability and also pricing issues and adjustments as we move forward.
Got it. Okay, so now that we know what a 409A is and why it's important, to Kayvon, if I were a founder and I wanted to issue options to a contractor or to an advisor at my company, should I be thinking about their hourly rate and set a valuation and give them shares or ownership based on the 409A?
Yeah, good question. So a lot of times some clients of ours will come to us and say, hey, we have this contractor, they're going to do, $50,000 worth of work for us. Can we just set that as the value, right? Here's an independent party to me. Can I just use that as the value? And the short answer to that is no, you can't. And it goes back to sort of the guidance of the IRS, where they're asking you to go to a third-party independent appraiser to do this just because you and another party agree to a number. That's just not sufficient to qualify that you are actually not going to be subject to these taxes and penalty under Section 409A. So that's one side of it. The other side of it is also something that, as a founder, I would strongly suggest you think about, which is a 409A valuation is specifically to comply with this particular section of the law. So don't use, so if you go and get a report, somebody might come out and say, your 409A for your common stock is 5 cents, or the value of your company is $1 million. Don't use that as a mechanism to think about how much to pay a contractor. Mixing these concepts together, there's nuances that will cause issues. And so what I would strongly suggest is, when you get a 409A valuation report, what you want to use that is to set the strike price of the option, which is something Tim will talk about a little bit more. So keeping these concepts separate is actually very important.
Got it. And Tim, what's the difference between options and shares? Why would I give someone one over the other?
Yeah, for sure. That's a good question. I think it dovetails a little bit into what Kayvon was just saying and the way to think about granting options. I think to step back from 10,000 feet up, an option grant, for those of you that don't know, is essentially a piece of paper to any service provider that says, hey, here's a contract to you. You are given the ability to purchase X number of shares of common stock in the company at a certain price. That certain price is going to be the strike price. That strike, stay with me for a second, and then that strike price needs to be equal to at least the fair market value of a share of common stock under 409A. So when we're talking about getting a 409A valuation report, we're talking about getting the written report from a third-party appraiser that's saying, company X, the fair market value of common stock for you is equal to 25 cents. So what that means is when you're issuing an option to someone, you say, hey, employee number 12, like I want to give you, to incentivize you to stick around for the next 3 or 4 years, I want to give you the ability to purchase 100 shares at 25 cents per share. So an option, now to get directly, Priya, more to your question, the difference between just giving somebody shares and giving someone an option. If Priya, if you're a founder of the company and I were to give you 100 shares as a co-founder, you own that 100 shares as of now outright. You get all information rights, you get all information, voting rights, you get any economic benefits of it. Now, if Kayvon is if Priya's and I's like third employee at company X, we say, hey, Kayvon, you're not part of the founding team, but we really value you. We want you to help us grow and scale this company. But you know what? You weren't here on day one, and we need you to stick around for at least 2, 3, 4 years. So, Kayvon, here's an option grant, and you're going to be able to buy 500 shares of our company at a strike price equal to 25 cents per share. And what that means is he does not receive his shares right now, but so long as he sticks around and provides services to the company, our company, for the next 4 years, after that 4-year mark, he is given the option at his sole discretion whether he wants to buy those shares for 25 cents per share. Now, there are tons of benefits of doing that, but from a tax perspective, corporate perspective, securities law perspective. But the big benefit for Kayvon is he's given the ability to buy shares 4 years from now at a price that's going to be equal to the fair market value as of today. So even when and if our company is grown and we're scaling, and 4 or 5 years from now, we're valued at $500 million, Kayvon's still going to have the ability to buy our shares at the price per share that was equal to the fair market value 4 years
ago. Okay. So, I think a 401(a) is important, and it sounds like I might need it. When's the right time to get one?
Yeah, I think it's interesting, right? Because there's so much ambiguity at the beginning of a company when you're starting it. So the question is like, these shares might not have any value. So why don't I just put it at par? And that's not the way that the IRS or your future auditors are going to see this. And I think if you think about the transition of your company, the transition of it is you're going to raise a couple of rounds. At some point, you're going to raise a Series B or Series C. And you're going to think about it from the perspective of the investors that are putting money into your company. So those investors, they usually have investors themselves. So their investors are endowment funds and very large LPs. So if they'll go to a fund, they'll say, hey, I'll give you $50 million to invest, but you actually only can invest in companies that have audited financials. So then the type of VC who's writing Series B checks, they might come to you and say, hey, I'm going to write you this check, but from now financials. And so when you go and get an audit financials, what ends up happening is those auditors, whether it's a big four or regional firm, they'll go and do what's called an inception to date roll-up. So they actually have to go back and say what has happened from day one, and they have to look at all the information around all the stock issuances. This happens both in an audit, or if you actually even get acquired, which is something that happened to us, and I'll also walk through what that experience was like. People will still ask those same questions. The stock that you have on day one that was 2 cents or 10 cents or $1, whatever it is, they'll ask, where did you get this value? Because what ends up happening is that as an acquirer, the acquirer is going to take on everything that comes with it. So if the IRS comes back and there's a liability because the stocks were issued incorrectly or there's no support, then the acquirer might come back and say, there's actually liability here. We're going to put more money into escrow, or you have to go and reprice this. So there's all sorts of things that you actually don't want to be in that position when you're trying to sell your company. And so this is a question of like, when is the right time, right? So day one, you might say, okay, there's no value here. And then on the day that you actually get a term sheet, you know that there's also value there. So there's sort of like some clear demarcation. But then there's sort of like an in-between that's a little bit unclear. So when we look at the data, companies usually raise their first sort of like institutional money sometime around a year plus or minus benchmark, plus or minus 6 months time. You can generally think about it if you have about 2 founders working on a project for about 6 months at about 50% of their time. I think that's generally about a good time for you to start thinking, okay, there is some value here, or that if somebody looks at this, they can ascertain value to the stock of this company. And at that point, especially if you think about managing your equity on Carta, you're managing your equity and you're getting your 409A sort of all in the same place. It's almost like an insurance policy for the stock and the options that you're giving out. Prior to that, probably a little bit early, but generally about 6 months' time, that's probably a good time to go and talk to somebody to figure out if there's enough value there that you want to document it and you have some documentation around it.
Got it. And what about between the 6 and 12-month periods? If there's a material event, do you think we need to get a new 409A? And what does it mean, I guess, to have a material event?
Yeah, good question. So as you might imagine, the value of your company will sort of like change, but it might be unknown. You might not know that. And obviously, if your stock is not trading like a public company, you might not know what is the value of your stock from day to day. So the guidance of the IRC 409A is once you get a report, that report is good for 12 months. So this is not something that you have to, it's not an exercise that you have to do every day. There's a caveat there, which is you're good for 12 months unless there's been a material event. And so generally you can think about a material event as a price round. So if there's been a price round, that's a good time to say, okay, this is material, let me go and talk to somebody. But let me just talk some nuance there that I think that would be helpful. So let's say you go and you're actually doing a convertible round. So before you didn't have any money, and now you've raised $1 million on a convertible note. But then a month goes on, and then somebody writes you another check for $100,000 on the same terms of that last convertible note. So it's a nuance. It's generally good to go and talk to your provider and say, hey, we have this additional money. Do I need to update this? What many valuation providers do is that they will have a forward-looking, so they'll have a conversation with you, say, hey, how much do you think that you're going to actually end up raising? The point of this is to find that balance between being compliant and not making sure and not making this be something that's dragging you from actually building your business. So case by case, but yeah, I would say keeping this demarcation in mind when you're considering issuing stock options. And generally, when you're working with sort of experienced lawyers, you can go and have a conversation with them as well, and they'll tell you, hey, this is a good time to go talk to somebody, or no, don't worry about it.
Okay, Kayvon, let me jump in and sort of ask you a question here, just based off your experience with the company that you grew and scaled. So just because I think I deal with this a lot with a lot of my founder clients, so it's nice to get the perspective of someone who's actually been a founder and when it scaled the company, not someone who's just a lawyer behind a computer screen. Is when you do a convertible note round, say the valuation cap in that convertible note is 15 million. Like, is it fair for a founder to think, oh, okay, that means that my 409A valuation is going to be equal to 15 million, and I can back into my common stock price using that valuation cap? Because I think that there's, and I know we're going a little off topic now, but I think that we hear lots of different like valuation terms. So it's valuation cap. Is that the same as a 409A valuation for 409A purposes?
Yeah. So the short answer is absolutely not. You definitely don't want to do that. You'll be doing a great disservice to your employees, right? So you want to compensate your employees for when they entered your company and when they're adding value, and the point that goes above that figure. And so anything below it, you're breaking tax laws. Anything above it, you're doing a disservice. So this is why you wanted to do this exercise. And let me just decipher about valuations, right? So a valuation cap is not the value of your company. A valuation cap is a future maximum price that you have agreed with your investors that their money could convert into your account. So there's a couple different differences, right? A is a maximum price, it's not the current price. B, it's a future price, it's not the price today. So you can back into what is the value of your company today, but then you have to do a little bit of math to actually figure out, well, if this is the maximum, this is future, and there's probabilities built into it, how can I figure out what is the value of my company today? So yeah, and then even after you figure out what is the value of your company, you have to remember, you have to work through the capital structure of your company, because the value of your company is actually allocated to the debt holders as well as to the stockholders, and then if you have preferred holders as well. And in each of those securities, usually when we go through a valuation exercise, the consideration is that this valuation is for a freely trading company, whereas that's actually not the case for a private company. So you actually have to go through a lot of mechanism to say, and support for the mechanism to say, well, this is the value if it was trading, how much does it allocate to the different shareholders and the debt holders? And once, if we're thinking about the common stockholders, how does that actually break out? So yeah, using a shortcut as opposed to actually getting a 498 valuation is definitely, what do they say? Penny wise, pound foolish. So don't, yeah.
No, for sure. And I just to dovetail on the point, I mean, I think you hit it like square on the head. You say it'd be a disservice to your employees. And a common conversation that I have, particularly with first-time founders, is they'll get back a 498 valuation and they'll be upset and disappointed and like, wait, what do you mean that the fair market value of my common stock is only 2 cents? And it's because there's so many different like valuation concepts go out there. And I think the baseline of 498, and for folks in the audience, whether you're a first-time founder or if you're working through this and this is new, is the baseline of a 409A is the strike price, the purchase price at which your employees are going to be able to buy their shares. So it's a little backwards when you think about it, but the lower that 409A strike price, the better. It's not an indication that your company's valueless. Like for tax purpose, maybe it is, which is a really good thing. But I think for employees and your service providers, it's always better to have that strike price low. So it's an interesting conversation that definitely sounds backwards, but it's an important distinction to remember that even if you're able to negotiate a valuation cap and a convertible of $50 million, like you definitely don't want to use that when you're backing into the fair market value for common stock for employees. Because at the end of the day, if I'm given an option grant and my exercise price is 1 penny, that's a whole lot better for me and for other employees and service providers than having an exercise price that's going to be to 75 cents.
Great. So you guys convinced me. I feel like I need to get a 409A valuation, or I need to recommend that to my clients for sure. So what's the best way to get a 409A valuation? Like, what does it look like?
Yeah, I actually want to just touch on one other thing that sort of Tim talked about, because we talked about convertible notes, and it just made me think about something, which is, so like thinking about pre-money, post-money, and price rounds. And I think that's sort of like related to the same conversation. And I used to give this analogy, worthwhile sort of bringing it up here, right? So say you have a building, and the building has 5 floors. And the top floor of this building is a penthouse. And the penthouse sells for $1 million. Right? It doesn't mean that every other floor is also $1 million. And I think that's sort of that's the analogy with a company. So when you go and sell preferred stock in your company, the preferred stock is the penthouse of the building. And so all the other floors, all the other shares are actually very different shares. They don't have liquidation preference. They don't have all these other bells and whistles that the preferred stock has. And so, there's not, when people get a 498, they're like, oh, this is like high or low, or like there's no number sort of moving around. What a 498 valuation does, it shows the reality of the company, which is the top floor that you've sold, the preferred stock that you created and sold, are just much more valuable than the rest of the capital structure. And so in this example, a $1 million top floor of a building that you sold 1/5 of it, incorrectly, you might say, well, my post money is now 5 million because it's 1 million divided by 20%. And that's sort of the math that folks do when they think about pre-money, post-money. Whereas the reality of it is, yes, this one particular tranche is worth $1 million, but the rest of the floors, they actually have different prices or different ways of going and figuring out what that actually is. And this actually happens in a lot of times where there's an exit and there's just not enough money for the common stockholders. They actually don't get anything out of the deal. And so what the 498 does is correctly account for all those bells and whistles. So I think that might, I've heard that's helpful, so I want to bring this up. but it's sort of like talking about sort of like how to get a 409A, right? And I think 409As are just so closely related to equity management, to issuing stocks and issuing options, that when Carta sort of started entering into this market and sort of bringing in a lot of expertise in-house and building software to integrate it closely to the way that we deliver services and provide software, I find it to be the best place to do it. And I'll give you that story about sort of like our acquisition. So we, as a 409A company, we only had very few shareholders. We had about 10 employees and a couple of advisors. And so I made the decision that we're going to do everything in Excel, and our lawyers are going to handle managing the cap table, because I didn't want our cap table to be on a competitor's software. Not that they cared, but I said, we just don't want to do it. It's like a massive company, they have their own business. But that's sort of what was going in my head as a founder. And while we were going through the acquisition, it's just all these papers and different cap tables, different Excel spreadsheets flying around. And as a founder, the stress level is just going through the roof. And the last thing that you're doing is you're pulling out papers, looking for signatures and making sure the dates are aligning and making sure the numbers are aligning. So anyways, afterwards, I became sort of like a big believer that even from day one, you really want your 409As and your equity management sort of like be in the same place. And I think Carta now does this for over 10,000 companies. And I think that's sort of like fully integrated experience that we have, keeping track of the equity as well as doing the 409A it would have been helpful for me. So I'm assuming it will be helpful for others, but yeah, that's I think is the best way. Really going through a third party independent that knows what they're doing is the key.
Got it. And Tim, when founders actually get their 409A report, what should they expect to see?
Sure. Yeah. But just a quick point that I agree with Kayvon's point of going to the third party, whether a lot of our clients, I'd say the overwhelming majority use Carta, so we love Carta and their services. But I think the one of the other big benefits of using that third party institutional, I'll call it, report is that it helps you fall within the 409A safe harbor. So if you're using someone who is a third-party valuation firm or offers those services, it helps minimize any risk that you're going to have, any exposure you're going to have from a 409A perspective. But then, Priya, when you get a 409A valuation report, you'll see a handful of things in it. But the underpinning of all of it is the 409A valuation is telling you what is the fair market value of one share of common stock of your company. Put in layman's terms, if you're a private company, how much could you go sell one share of common stock to your neighbor for? There's no public market for private companies per se, obviously, because private companies aren't listed on public exchanges. So it's how much could I sell a single share of my startup or Series C funded company to somebody on my street? So then you look at the 409 valuation report, and there's going to be a handful of things in there. Some are going to be the data points that you give to this valuation firm. So if you're a founder and you get a valuation report back, you should check all the boxes to make sure that the capitalization figures are correct. Your financial metrics that you provided to the valuation firm are going to be in there. Make sure your valuation metrics are correct. The valuation report's also then going to use some public company and other like comparables to say, okay, yeah, we see you have a fitness studio, you have a fitness app, you're similar to Beachbody Fitness, you're similar to Peloton, you're similar to someone who has a public market. We're going to discount a little bit for marketability. So there's going to be a ton of comparables going through there. I'm looking at one right now. There's going to be different methodologies used. One of them is like they're going to look at the market approach. They're going to look at public company standards. That they're going to look at like your potential M&A opportunity. So long way of saying there are data points in the 409 evaluation report that you're going to want to review and make sure that they're correct. And then two, you're just going to flip through and you're going to say, okay, this third party who's paid to do this for a living, this is how they landed their analysis. And you're going to review it and you're say, okay, looks good. Or you can set up a call and have a conversation with whoever your point of contact or contacts are, the valuation firm, to determine whether or not you agree with the report.
Yeah.
And then
I would, sorry, go ahead, Tim.
Oh, so yes, just one other point that I wanted to make. So it's in a good guiding post. This is like the old rule that we used to go by 10, 15 years ago is if you've done a recent preferred stock preferred round. So if you've sold Series A, Series B, C in a priced round, and then you get a valuation report shortly after it, which all companies should. We'll talk a little bit more about that when we get farther along. Your strike price is going to come somewhere in the 20 to 30-ish% range. And what that means is, to Kayvon's point about selling the top floor of the skyscraper, if you sell preferred stock at the top floor for $1 per share, your strike price for your common stock is assuming a lot of assumptions, but the general rule is your common stock price is going to be somewhere between 20 and 30 cents. So if you see something in that window, it's like, okay, this is probably right. Let me read through it. If you see a strike price that comes back at 3 cents, review it closely and talk to someone and find out why the valuation team came back so low. Or if you see a strike price that's 85 cents, same thing, have a conversation and make sure that they actually have backing to help you land where you're quote unquote supposed to be within the 409A guardrails.
I'll give a couple of sort of like examples or nuance of when sort of some of those circumstances will happen. Sometimes preferred stock, a lot of the language that you would read, the preferred stock will have dividend clauses, but it will say it's only applicable, only payable if it's declared by the board. And so that's a pretty standard language that you'll see in articles of incorporation. There are some instances where we say that it would say the dividends are going to actually accrue regardless of it ever being declared. And so in those cases, the preferred is going to have a lot more of an overhang on top of the common stock. And so in those valuations, we'll see the common stock getting pressured down. The sort of like other side of this case is when a company is in negotiation for a transaction. And so if that is the case, then that becomes an additional data point where the valuation specialist might consider that, and that will also then push the value of the common stock to go and move towards what this potential exit would look like. So there's a lot of sort of like nuances, both from a business perspective as well as from the capital structure perspective, that will impact the valuation. And that's where sort of our team here and valuation specialists will consider when they're going through the exercise. Yeah.
Got it. And once the 409A report is actually received, what's the conversation between the board and the founders of the company and the 409A provider before a company can take that 409A report and start issuing options based on the price?
Yeah, sure. I can jump in there and at least give an initial answer. I mean, I think there's a couple layers here. The first layer is whoever the founder, the COO, whoever that day-to-day business operator is, will want to do that first pass at evaluation report to check the boxes that I mentioned, make sure the data points are correct. The next level and the final level of it is the board of directors, whether it's a single person director or more likely a 5 to 7 person board set up now, they're going to have to review the valuation report and they're going to have to approve and adopt it. So you take the value after we get through that initial screening, the valuation report is then sent to the board of directors to review and say, hey guys, we agree with this, thumbs up, let's approve and adopt it, now you can give option grants. Or the board's going to say, you know what, like this seems a little off, or I disagree with this assumption. Can we discuss these items with the valuation team? And then someone from the company is going to go have that conversation with Carta or another third-party provider and say, hey, we reviewed this with our board. There's a little bit of reluctance on approving this, and this is why. Can we have a discussion? Sometime pre-COVID, a lot of this was done at in-person board meetings where the board would sit around and be on a PowerPoint, discuss it, review it, have an open dialogue. I'd say now, in my experience, this is more often than not just done over email, sort of on an ad hoc basis. So it's once founder confirms data points are correct, it then goes to the board. If the board has any questions, we take them back to the valuation team. If the board does not have any questions and it looks good, the board then either at a meeting or by written consent will approve and adopt the valuation.
And just sort of broad brushes, right? There's and there's again, this applies to some, but not all. Right? I can almost think about three that happens from very late to very early. So very late stage companies, what the considerations that the valuation specialist is going to have is going to be around the business model itself and what their exit is going to look like. So they're thinking a lot more about the revenue and their cash flows, potentially what the exit looks like. So that's sort of like what happens at the later stage. One stage prior to that, really what the valuation specialist is going to look at is going to be the pre-post money value that the investors have given the company. And then they're going to try to figure out sort of like about that adjustments that happen. So it's like, okay, if the penthouse is worth X, what are the other floors worth? And sort of that's the lens that they're looking at it. Earlier stages, when you have a convertible note, a lot of times they're looking at how much capital has gone into the company, how much cash do they have. They might look at the valuation cap. And in very early prior to a convertible note, what they're going to look at is through this lens of, it's called the replacement cost new. Essentially this question of what has gone into their company. If we were to replace what has actually been done, what would that cost? And let's try to quantify that. And so that's sort of like the end-to-end, almost like narrative that applies to a lot of these different companies. There's nuances for each of them, but you can almost think about it that at each of these stages, the valuation specialist is going to look at different things. Revenue and earnings are not going to be applicable to some early stage companies. And so those are the things that we think about when we go through this exercise. And I think ultimately it's also helpful to know what is the job that you're trying to get done, right? Like, why are you doing this 498 in the first place? And really the reader of this is going to be a Big Four auditor who's going to try to make sure that your books and records are correct a couple of years down the road. The auditors of a potential buyer who's considering buying your company, and they might be trying to, or an attorney who's trying to find more ammunition for their clients to see, hey, how can we do something here? Or the SEC. So the SEC is going to be thinking about, okay, you're about to go public. Did the stock options that were granted over the life of the company, were they granted correctly? So those are really the readers of this document. And I would say as a founder, really, if at the end of the day, if you issue somebody stock options with a purchase price of 20 cents versus 18 cents, that might have a little bit of difference. But if you exit for 50 million versus 100 million, that's really where the difference comes. So you're going to have a limited amount of time. And so really pick your battles and say, okay, I want to make sure that this is going to pass muster. The information is correct. I got it from a reputable firm. And then after that, once those things are checked off, you have a million other things on your plate. Focus on those.
I totally agree. And I think that's a great point, great like real world tip, practice point, based on your experiences, both on the company side and now in your new post. And I think just on that, I just want to jump in sort of as like the real world practice point that I'd like giving entrepreneurs to founders is it ties in with the point of this presentation panel we're having right now, and that is how to get equity awards to your service providers to incentivize. And how do you do it within the guardrails of 498? So most companies will grant options sporadically. They'll grant options every quarter. They'll grant options when they hire people. They'll grant options monthly or at every board meeting or annual. I think we tie back now into one of the earlier points is how long is a 409A valid for? 409A is going to be valid for at least 12 months, as Kayvon pointed out, unless there's a material event. So for our purposes, at least for emerging growth companies, most startups, that material event is going to be when you have like a priced financing round. Kayvon mentioned that earlier. So our real world practice tip and point that we always stress to all of our clients is, hey, we know that you may be wanting to do option grants only quarterly to save on legal costs or for administrative reasons, but you always need to have this in the back of your mind as a founder, that it's not when you close a preferred stock financing round that your 409A goes invalid. The general rule, and I think it depends on how aggressive you want to be, is The second you get a term sheet that you have a reasonable expectation of accepting is when your existing 409A valuation goes in value. So let me just play out a quick example. If in January you hire 15 employees and you want to give them option grants, you tell them in their offer letter they're going to get an option grant, but you're going to wait until the board approves it. Generally, your board will approve option grants on March 15th of every year. So you as the founder and the employees are, cool, I'm getting my option grant at like a really good strike price, but it's going to be in March when the board has their next meeting. But then let's say on March 1st, you get a term sheet that says, hey, we're doing a Series A priced round at a $20 million pre-money valuation, and you sign it. You can't then give options on March 15th to these employees because you don't have a valid 409A. So that's not really great for your employees because they're still going to be able to get their option grant when you get a new 409A after your Series A round closes, but they're not going to lock in that early strike price. So long way of saying the practice tips that we always give to all of our clients, and we harp on it all the time to make sure that people stay ahead of it is, hey, if you decide that you're going to go down like a financing, not everyone does a roadshow, but it's an easy phrase. If you're going to do a financing roadshow in Q2, for example, make sure you get any and all pending option grants approved by the board at the existing 409A valuation before you go down that path. Because it's not going to be the closing of your preferred stock financing round of when your 409A valuation goes stale. It's going to be that there's like a blackout period from the time you get a term sheet until after the financing closes, and then when you get a 409A valuation back. So there's anywhere from like a 3 to a 6 or 7 month period where you're not going to be able to grant options to any employees. So real world practice tip, keep that in mind. And when you think a financing is going to come, make sure you clear out any and all pending options.
Yeah. And just, I mean, if you really think about it, again, there are two sort of like elements that are at play here. One is this valuation, one is the state of your cap table. And I think, again, having those sort of like end to end together will actually solve a lot of things that Tim is talking about here. If for example, you go through the process with Carta, we sort of ask you these questions, you know what to expect. Again, ultimately, you're answering to these future auditors. So future you will thank present you for doing the right things. So consider those.
Yeah, a question that I often get from clients is, they're just doing their business and all of a sudden someone just sends them a term sheet. They haven't signed the term sheet, but they just got one on the table. Is that enough to trigger a new 409A report, or do you think they should wait until there's a signed term sheet on the table?
I think it's a little bit of a gray area. I go back to our disclaimer from the beginning of this meeting that this isn't legal advice. But I do think, and all kidding aside, I mean, I think if you get an unsolicited term sheet and it comes out of nowhere and it's like, yeah, I don't think we're actually going to pursue this, you're still in probably the clear. But if you get an unsolicited term sheet from a COSLA and you see it and it's like, yeah, I'm going to sign this today, you can't rush and grant options that morning and be compliant with 409A. It's unfortunately that's just the cost of doing business, the cost of being really successful. And there are ways to get the employees or service providers to the same spot they wanted to before. The math isn't going to add up. But if you were planning to give an employee an option grant for 100 shares, but then the strike price is going to be incrementally higher because of this new round, you would then just like top up that employee and instead give them an option grant for 180 shares or 200 shares after the financing round. So I think it's a gray area. If the term sheet comes, the direct answer, if the term sheet comes across and there's a reasonable expectation that you're going to sign that term sheet and move forward with that term sheet, you're in that blackout period to make sure you're staying compliant before.
Yeah, I'll give sort of like a real world example of this. So we had a client years ago. We did a valuation for them. We asked all the questions that you have to ask. This is maybe 6 years ago at this point. one of the questions we ask is there a term sheet coming? Is there financing coming? And they said, nope, everything's good. Cool. A month goes back. They come back. Hey, we need to update our foreign NA. What happened? Yeah, we got $20 million. Okay, this doesn't quite add up, but you sure you didn't have this? It's like, yep, everything is good. Great. Fast forward a year later, now they're a Series B company, so they have to get audited. So now their auditors came back and say, how did this happen? I see a stock price options issued at 20 cents, and now that's 70 cents a month later. Can you tell me about these 20 cents options? And I was like, well, we actually didn't know that this is going to happen. Anyways, long story short, they have to go back and reprice those 20 cents options because the auditors were just not comfortable. And the narrative was that there's not enough substantiation that within 3 weeks, you went from a handshake to $20 million. And the audit firm did not feel comfortable. So ultimately, they have to go back and redo this. And so I think that there's enough transparency. Well, not enough. There's some transparency in the world, but I think there's going to be more in the future. And I think the right way of doing that would have been to have a discussion with your 498 provider and saying, hey, we have a term sheet now. These are the terms. And then we can actually look at our data set and say, what does that look like? So add a term sheet, you might have a 30% probability of actually closing this. So you can actually create these different scenarios and saying, scenario A, you're going to go through this, you're going to have your term closed. Scenario B, business as usual. What does that look like? And then you come up with a blended price for those stock options. And then that way, if they come back to say, you can say, yes, we were in the process. This is how we thought about it. So always, again, better to have a conversation as opposed to sort of winging it.
Yeah. All that makes sense. I mean, do either one of you kind of have any closing best practices or, thoughts that you want to get in about advising your own clients or?
Yeah, I think a couple of questions that were in sort of like the Q&A that I saw, and there was a pattern. There was a question around is issuing for first employees. Do you need to get a 409A? And again, I think using that sort of like 6 months timeline, even if you're bootstrapped. So the mental model or the mental math you want to think about is, would I just give my common stock to somebody at X price? And generally the answer to that is no. Like, you've created some value. And so it's probably less than the value of the stock after you go and do a raise, but it's probably not zero. And so it's just good housekeeping process to go. If your company is successful, if your company is unsuccessful, who cares? But if your company is successful, you're going to answer to this question to somebody, and it's better than that you have that answer now, as opposed to later, because the cleanup later will cost you 5 times more.
Yeah. Great. Well, I think we're trying to move into some Q&A. Grace, do you have some from the audience?
There are a plethora of questions, so I want to make sure we have enough time for some of these. A popular question from Eton: does a brand new company hiring its first employees need a 409A valuation before granting options to its first few employees?
Yeah, I think the echo of that, I would say yes. You're always going to need a support for why your price is the price that you said it is. Even if the price is nothing, that's fine. You just have to have support for it. If you want to provide that support, that's not great, but have a support. Just know that in 6 years, when you're running a hopefully $50 million post-money valuation company, do you want to go back and answer that question to a Big Four regional firm as to why you did the thing? Whereas you could have just done the study, would come out at 3 cents, 4 cents, or whatever, and you've sort of like closed that chapter and you move on. So I think innovation other places, not against the IRS, because you're just not doing that at scale. So.
No, I agree with that entirely. And I think remember that the IRS is undefeated when it comes to battling companies and individuals. There's no beating the IRS. So I think if it's to the point that Kaylon made earlier, if you're giving an option grant to someone at a strike price that's 3 pennies versus 1 penny, yeah, it's real dollars, it's real money, but that's so much smaller than looking at an exit valuation of $100 million sale versus a $50 million sale, or the $100 million sale where you need to put $15 million into an indemnity for potential claims. So err on the side of getting the valuation. I'd say always.
Rebecca wants to know, how do you answer someone who asks what the current value of the stock is? Should you give the FMV or the price investors paid at last financing round? If it depends who's asking, what would the answer be for employees receiving stock options who want to know the value of those options?
Yeah, so I can give my thoughts, at least from like the legal and also practical end. And Kim, I'd love for you to jump in too. I think it does depend on who's asking, and I think that you frame it a certain way regardless of whoever you're giving your answer to. I'd say for employees, what I would generally tell them is, hey, your option grant is gonna have a strike price equal to the fair market value as determined by the board and a third-party appraiser. So that's going to be the FMV from a valuation team. I then like saying that if they're like, okay, but how much does the company actually worth? It may be the lawyer in me, but I like giving sort of general answers. And what I mean by general answers is, hey, it's tough to pinpoint an actual value on the company, but we did just raise $25 million at a $75 million pre-money valuation, and you peg it at that. Because the last thing you want is someone to then have come back, whether it's not going to be valid, but come back to you and say, hey, I'm suing you. You told me my stock was part of an $80 million company. I own 20%. You owe me $20 million. Or my math is wrong on that one for sure. It would have been, there's ways to frame it, because there's, unfortunately, unless you're a public company, there's not a direct answer to these questions.
Yeah, this is just my perspective on this. So I'm on the complete opposite side of this. So and I don't have that many. I've only ran and successfully exited one company, right? So the way that I ran my company was full transparency on everything. So everybody knew how many shares everybody has, what's their strike price, what's our valuation, how much revenue we have, how much cash we have, all the mistakes we've made. It was a small, I've never done this at a larger than a 10, 15% organization. So don't quote me on this. But it was an incredible weight off of my shoulders. I wasn't trying to think about a narrative. It was, this is the price that we raised. This is the value of the preferred stock. They're more valuable because they're better stock. Your strike price is this. We received it from Carta or whoever else because they went through this exercise. What that means for you is X. When you exit as these prices, you're going to have this much ownership that's based on your shares. This is how much you have to pay to actually get those shares. I just tell everything because I think at the end of the day, doing startups is really hard. And the people who are going to be around, they're going to be around because they like solving and they like you and they like the team that you've got together. If somebody's trying to come work for you because they think their full package is 150,000 versus 175,000 or whatever that number is, that money would just burn out so quickly. I mean, that the dollar value will go away. The amount of work that they have to put into to make your company worthwhile is an unreasonable amount of work. So no reasonable dollar compensation will ever compensate for it. This is just a nice to have. So that's my take on it.
I love some good opposite opinions here. This is great. This is perfect. Okay, a question from Oksana. What if the U.S. private company has no U.S. residents, employees, founders, and contractors, and hence all options granted are granted to non-U.S. residents? Is 409 valuation still required?
So it's the answer is nuanced. It depends on what jurisdiction folks are in. And if someone is in a non-U.S. jurisdiction, and I'm happy to take this offline, my contact info is on our website if you have any questions, but if it's a non-U.S. jurisdiction and you create a sub-plan in that non-U.S. jurisdiction, you can grant options compliant with that local region within what is acceptable. A quick example is in the UK, HDMI options don't need to be struck at the 409A strike price. So there's a different regime that other jurisdictions are going to follow.
There's another part of this, which is 409A. We're talking about the recipient and tax consideration. But there's another part, which is as a company, you also have to report on non-cash compensation. That falls under what's called ASC 718. Under ASC 718, you have to report what is the fair market value of the options that were granted, what was the stock, a lot of things that fall under equity management, which sort of Carta handles. But again, you need to know what is the valuation of your stock, and you need that for ASC 718 reporting. Whether or not you need it right now or later, that's a different conversation. But again, something that our team can help answer that.
Perfect. Well, there's still like 9 million questions in here, but like Tim said, if you guys want to reach out with your specific questions, the Goodwin folks are happy to receive those questions. Thank you all so much. This was a very informative discussion. We really appreciate your time. And like I said at the beginning, we have 2 more sessions tomorrow and Thursday about different legal topics that we'd love for you all to join. So if you're already in the platform, you just join like you joined earlier. It's the same place, same link. Thank you, Tim, Priya, and Kayvon. We really appreciate it, and we hope to see you all soon.